Dumb money FOMO, FinTwit bear flipping bullish. Is this the short-term blow off top? 3 months ago, the narrative was don't fight the Fed. Now it changed to fight the Fed. It's a new AI bull market. Never underestimate the stupidity of the stock market and how long it can last. So as you guys can see right here, this is the smart money, dumb money confidence, guys. And right now, everyone is capitulating on the bear side. And as you can see, the red line right here, this is dumb money is FOMOing right in this market top right there. It has been very, very good at indicating when you do not want to be buying stocks, okay? And right now you do not want to be buying stocks in the same time that dumb money is buying. This is literally the blow off top every single time. This is the extreme that I was waiting for in the markets. And as you can see, the blue line, which is smart money, is not buying. They're actually selling stocks. On this chart, I wanted to show you guys basically the blue line, which is the SPY, and the red line is the Fed liquidity. And I wanted to show the bearish divergence that we are having right now with the Fed liquidity and the SPY. So as you can see, the S&P 500 right now is doing a higher high, but the Fed liquidity is about to do a lower high. And we had the same exact setup, guys, right before here, where we had a higher high and then a lower low in the Fed liquidity. And right after what happened, we went right back down to the low right here, right? Which I called in my prior video. So right now it's basically kind of looking like the same setup. And it's also the same setup because in the same time, we have the money again piling in, FOMOing right in the same time. So it's literally the same exact setup, guys. So we got dumb money FOMOing right before we have a nice leg down and we have a beautiful bottom here, which is coinciding with this bearish divergence again between the Fed liquidity and the S&P 500, which created afterwards a beautiful move down. And then we bought right here and then we go back up. And I think the exact same thing is going to happen. We're going to go down and then we're going to go higher to 441. Right now, everyone is flipping bullish, guys. This is a Barron's cover. Shout out to Kitty. I've been getting a lot of alpha from him and I've learned a lot from this man. Shout out to him. So basically right now, everyone, guys, is flipping bullish. Okay, don't fear the bull market. Why stocks are heading higher. Here, we got Wall Street biggest bear admits defeat. Okay, right here, we got the Bank of America. Bye-bye, bear. So now, basically what is going on right now, guys, is that all the monkeys that did not want to buy when the market was at 360, 380, okay, and 390, is now telling you guys to buy when SPY is at 430 and the VIX is at 13. This is the AAII bull survey, which is very important to look at. And finally, guys, it's picking up. Everyone is turning bullish, okay? And this is what you want to see right before we have a nice correction in the market. Right here beneath, we have another sentiment chart that's very important to look at, which is the allocation cash. And as you can see, guys, well, this was not updated, but when it does get updated, I have a feeling that it's going to be very close to the red line, guys, which is not where you want to buy stocks. Right here, guys, we have the perfect recipe for a beautiful market correction. We have everyone flipping bullish, all the bears flipping bullish. We have dumb money FOMOing at the top. We have everyone getting rid of their cash, buying stocks. And we have the bull sentiment in a straight parabolic line. This is the perfect market recipe for a beautiful correction. All right, so I understand you guys have a lot of stuff to do, so I don't want to waste your time. So we're going to jump right in the key levels that you need to pay attention for the next coming months. I'm going to show you the standard deviation and the probability of distribution on the daily time frame of the SPY, and also the seasonality cycle of the S&P 500. So as you can see right here, guys, we are entering a bearish seasonality cycle right here for the S&P 500. As you can see right here, we were bullish and we did go up. Okay, guys, we did go up. And by the way, this low right here was called. in my previous video. In this video called Smart Money Buying and Dumb Money Selling right here. So if you're interested, you can go watch this video and see it's the exact same thought process and same market analysis that I did 2 months ago, and we caught the bottom. And right now, this is the same analysis that I am doing with you guys. And right now, I believe that we are about to have a beautiful summer correction. And my PTs basically are the reversal to the mean of the standard deviation range of the daily time frame, which is about 421, okay, in this ballpark. And then my second PT to the downside is going to be in the ballpark of 407, 404. In that ballpark, that would be very nice. That would be a second standard deviation, which is the purple line right here. These right here are super important, guys. These are dark pool magnet zones. By the way, those are key levels. You can take a screenshot right here. So we got 425, 421. Obviously, we got the 412, 411 right here. And then above the next key level, if we do drop, which I'm seeing a nice, beautiful drop, but then I would not be surprised if we then go back up. I think that this is going to end up being a buying opportunity. For now, obviously the market structure could change, but for now, I think this is going to be a beautiful buying opportunity during these seasonally weak months ahead. And then the next PT to the upside afterwards, which are dark pool key level magnet zones, is going to be between 438 and 441 on the S&P 500 to the upside. So do keep in mind those key levels. But before that, I do believe we will have a leg down. And then all the bears are going to come out and try to scare you and tell you, oh my God, we're going to crash. And guess what? It's going to be a beautiful buying opportunity. Here as well, this is basically the standard deviation pivots. And right here, you can see that this is basically the plot of the standard deviation pivots on the daily time frame. And we also have an order block right here, which is between 407 and 404. So basically, that's pretty much where I think we're gonna go. We are definitely gonna fill this beautiful gap right here, and then we're gonna flush down here, and then there's gonna be a lot of people shorting and hedging themselves, and then I believe we're gonna have a beautiful leg up to the 438, 441 zone, and then guys, bigger picture. Then I do think that's going to be close to the top, and then we will have a big leg down. That would not surprise me whatsoever. But right now, the market structure, obviously, if you look at the trend of the standard deviation range, it's to the upside. It's a very nice trend. So I would be very careful being a bear on the short to medium term, even though we're going to have a beautiful correction. All right, so QQQs. So QQQs is less interesting for me because the standard deviation range is smaller. So there's just less volatility. If you want to play it, you can play. But I believe that SPY is just more interesting because there's a bigger range. But the PTs, basically the first PT is going to be, again, the green line right here in the middle, which is the reversal to the mean of the standard deviation range. And my second PT will be right here, which is the purple line, which also coincides with the reversal to the means of the bigger picture standard deviation range on the daily. So right now, the market darlings, okay? Real quick, just wanted to show you guys Apple, Tesla, and Nvidia. So Apple is actually extremely bullish, guys. I would be very careful in trying to short this. The reason why I say this, you see how tight the LRC is? The linear regression channel of the standard deviation is. This is really, really tight. This is a terrible risk reward to short. And bigger picture, if we do afterwards bounce and continue upwards, Apple has room to about 190, 191 before it tops. But personally, I'm not interested in Apple. I don't think it's a good risk reward. Next is Tesla. Okay, guys, Tesla had a beautiful run. By the way, we call this entire run on this channel. I bought right here at 165 approximately, based on seasonality. And you can go check that video right here. It's a short. It's 30 seconds, guys. You can go look it up. It's right here. It's A plus setup trades Tesla. It's 30 seconds. I call the entire move using standard deviation. If you're interested, go look it up. It's a really good video. Yeah, so basically the probabilities for Tesla is going to be basically right now we are at the second standard deviation Full disclosure, I have a bearish call credit spread on it now. I'm up about 16%. The first PT will be again the green zone right here, the green line, which is the reversal to the means, and then the second one is going to be the purple line, which is about the first one is about, this is 190, 190, excuse me, it's hard to write with the mouse, and this is about 150, I think 150, 140, in that ballpark. Do go to the second standard deviation, guys. This is going to be a buying opportunity. Okay, do not get scared. This is going to be a beautiful buying opportunity. All right, so Nvidia. All right, so this one, guys, it's going to be the monthly chart. I just want to show you guys quickly how to use standard deviation on the monthly time frame to find the fair value of stocks. So on the bigger picture, basically, you see, this is why you don't want to be buying. Okay, when we are outside, this is 4 sigma, guys. Okay, 4 standard deviation. You don't want to be buying a stock at 4 sigma on the monthly. And as you can see, what's happening, we're getting rejected. We will gap fill. Okay, this entire 20% or something, we will gap fill. Bigger picture, the fair value of Nvidia is again the reversal to the means, right, which is the green line right here, which is about 260 and 270. So keep an eye on this, put some alerts. That's going to be the good time to buy. And as you can see, we have some nice projection right here, Fibonacci projections going back here. This is going to be the zone where if you do want to add to your position like me, I'm up about 120% on my position, but I'm not selling, but I also am not going to buy at these levels. I understand the fair value of stocks, and it will go back at these levels in the next 3 to 6 months. Just be patient. So yeah, I just wanted to show you guys quickly, how to use these levels, which are the best way to trade in my humble opinion. Because of that, I've went from a 70% trader to a 90% trader. So that's pretty cool. All right, so now let's make a deep dive in the internals. Okay, so basically the way I like to trade is I like to combine the internals in the markets with the standard deviation and the probability of distributions in the markets. So right here we got the smart money and dumb money confidence spread, which obviously is telling you that you really do not want to be buying right here. Okay, this is not when you want to be buying. You want to be buying when we are right here. Is the risk appetite index as well. This is really bearish, guys. Short term, we will have a correction. This is going to go down. This is an extreme in the internal. So this is what I like to search inside of the second and the third standard deviation ranges. When you trade it that way, you become a really accurate trader. This is the liquidity premium of the SPY. So basically it's the difference between are people buying more of the ETFs or people buying more of the stocks inside of the ETFs. And when people are buying more the ETFs than the stocks inside of the ETF, well, it's bearish because it means that people are kind of scared to buy individual stocks. So instead they edge themselves by trading ETFs. And as you can see right here, you really do not want to be buying here. Again, you want it to be buying here when I call this bottom right here. This is the QQQ liquidity premium, same, right? You want to be buying here, buying right here. Okay, we had that beautiful flag as well, and then we had the breakout, and now everyone is chasing the breakout, but no one wanted to buy right here. No one. The same monkeys that did not want to buy here when VIX was at 30, 25, now want to buy when the VIX is at 13, and we just had an expansion pattern. Next, we get the P/VIX spread, very important to look at. This is really not something you don't want to be buying here, guys. Just wait. We're going to go back. Just be patient. Just have some cash. Know what you want to buy in advance. Know your key levels, like the key levels I showed you already, which is where I expect the SPY and the QQQs to go. And yeah, you're going to be very happy in the coming months. The 10-day breadth in the S&P 500 is also at an extreme. The 50 breadth is, it's okay, but we have bearish divergence right here. SPY keeps going up, but the breadth keeps going down. That's not bullish whatsoever. Same on the 200-day average, right? So the big divergence here. All right, so here, the red flags. And this is why I am calling this a bear market rally, guys. This is not a bull market. So all the people in finance right here, okay, calling this a bull market, and this woman admitting that, the bear market is ended and now calling it a new bull run and saying it has legs right here. Okay, this is just, these people are not very competent in my humble opinion. This is pretty sad, but I'm going to explain to you guys why I believe this is a bear market rally by showing you the 80 line. Okay, so basically here in the New York Stock Exchange, this is the 80 line that I like to use. This is the normal one that everyone uses, including me, that has ETFs inside. So it's stocks and ETFs. And as you can see right here, you know, it's obviously it's going down and we have bearish divergence again, right? I've been calling this in some of my other videos as well. The bread tried to pick up a little bit right here, you know, in this little right here, try to pick up, but it's not, it's actually disappointing. I'm actually quite, I'm not really impressed by this trust of bread right here. It's terrible. But this one beneath is even more bearish. Okay, guys, so this is the same AD line, but stocks only, no ETF. Okay, and I wanted to zoom out to show you guys how bad this is. This is really, really bad. This is not a bull market because of this, guys. And then something else I'm going to show. But you see here, like, you know, the AD line goes up, right? We go up, right? It follows. Like if you look, we go down, right? We go down. Okay, we go up all this. We go up. Okay, anyways, right? You know, during COVID, we crashed. It crashed, right? Stocks only crash. But now look at this, guys. Since the beginning here, this thing keeps going down. And now look, the SPY is going up, guys. This is the first time since 2000, the 2000 years, that this has happened. That the AD line, stocks only, continues going down and the SPY is going up. This is not a bull market. This is, you cannot call this a bull market when the SPY is going up and this AD line, stocks only, is going up. And now everyone is calling this a bull market and we're gonna go back up. I believe we're gonna have a nice leg down. Okay, and then maybe if the bread does pick up, we can then bounce. But right now we're ripe for a beautiful leg down. This is not normal, guys. This is really not normal. Since the beginning of this rally, right, which is about right here, this line. Look at this. It keeps going down and we keep going up. This is really not normal, guys. You see here, the beginning of the bull market, the entire bull market of 2022, right, we went down. It also went down. That makes a lot of sense. Right now it's still going down and we're going up. That's not a bull market, guys. And then this one, right? This famous chart right here that everyone's talking about. Okay, we got the SPY, the QQQ up here, right? Right here, going up about 30%, right? Crazy, right? And then here, this is HYG, high yield credit spread, guys. Okay, it's not moving. And as you can see right here, guys, this is the COVID crash, right? Everything crashed together and everything goes back up together. Even during the bull market, the bear market, excuse me. Right here, we went down, right? It all went down together. We had the bear market spikes. It also spiked with the ETFs. Then we went down, they went down together. Went up, they went up together, right? Right here, right? Go up, go down. But now, look at this. We're going sideways, guys. This is telling you that the market is pricing in that we're about to hit a recession, that we are not in an economic expansion, that there is too much risk right now buying this ETF, and it's yielding about almost 6%, guys. And the market right now is basically saying that it's too expensive. That's why there's no bid, and that's a kind of flag. So this could break down, guys. If we do have a nice correction right here, we could have credit yield break even lower. And all of this, guys, only 8 stocks in the market did this. 8 stocks of 500 stocks. This is not a bull market. All right, la pièce de résistance. I'm trying to make this video quick for you guys. So this is la pièce de résistance that you really need to look at, guys. This is the equity in edging index. As you can see right here, the entire bear market right here, right? We went down, right? But look, everyone was hedged. You see this? Everyone was hedged. This is why we had a control selling, guys. It was not a flush like in 2020, the crash. Okay, that's a crash right here. Okay, and you can see no one was hedged, right? No one was hedged, and then that was about here, right? And then boom, 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 and then boom, we crash. And then at the bottom of the COVID crash, everyone started edging their portfolios, and then we ripped right back up and they lost money on their edges. Okay, in 2022 it was the complete opposite. Everybody was edged, so that's why we only had this type of selling, which was controlled. Right now, look at this, guys, and this was not updated. This is the 2nd June. Okay, guys, this is right now. When this gets updated, I think we're gonna be very close to the red line. Okay, if you're a bear and you want a nice correction, this is what you want. When we hit this right here, guys, okay, I'm telling you, we're gonna be very close from a nice correction in the market, and then this will bounce, obviously, and then everyone's gonna be scared again, and then they're gonna edge the portfolio. Right now, this is a perfect recipe if you want a beautiful correction in the market. No one is edged, okay, and everyone is calling for a new bull, AI bull market. Okay, last puzzle that I want to show you guys is this, the VIX edging position. Okay, keep an eye on this. This will spike before the VIX. Okay, this vol is a leading indicator. It's gonna spike before the market tanks. And you can also use this with the skew index as well, which is also predicting that we're gonna have a nice market correction in the next coming weeks as well. This is the dollar right here. In my humble opinion, I think the dollar has room to 110 right here, which is the reversal to the means of the standard deviation range on the weekly, if we do have the market correction. All right, guys, so I apologize if this is long. I hope this was helpful. This is the last chapter of this video. Basically, I just want to show you guys the positioning of the bigger players right now. And the reason why I wanted to put this in the video is because they actually do not agree with me. And that's why it's important when you're screening the markets. At the end of the day, we're here to make money. We're not here to have a bias. Okay, that's not how you make money in the markets. And it's important to look at other things that are basically contradicting your thesis, right? And so right now, hedge fund exposure is extremely low, guys. Okay, and it's always, strictly speaking, a good time to buy when hedge funds are not in the market. Okay, so this is basically saying that it is still a buying opportunity because hedge funds are still not really in the markets. So that's an interesting point of view. We also have the edger combo, which is also in the green zone, which is basically telling us to buy, just like during COVID, right? It's been in this zone since the low, guys. But I think that this will flip at one point. As you can see, this is not normal. It's been up for a very long time. It will go down, so this is why I'm kind of taking this data with a little bit of not taking it too seriously. And then below you get the speculator combo. This is just 50-50, not really interesting. And one last right here, just the positioning of the dealers, which is very important again. You can see right here they're getting out slowly, but they're still net long, so they're not net short. And the small players, the green line, well, they're net short, and usually we don't have market corrections when they're net short. So net long, excuse me, no, net short, I apologize, the green line is missing my eyes. So that's something to keep an eye on. As you can see, during the top, the green line was net long in the market and the dealers were short at the top. So it's a good indicator to keep an eye on. And right here, I want to show the discrepancy between the SPY and the QQQs. Basically, as you can see right here, right, the dealers are net long on the SPY, but they're actually now very close to net short on the Qs, which is very interesting. And they timed this entire rally perfectly. Also, they're very good at timing the bottoms and the tops, and right now they're very close to calling a top in the Qs, so I would be keeping an eye on this. And that's pretty much it, guys. I hope it was useful. I apologize if it was too long of a video. All right, have a good one and take care. Stay blessed.